Hey traders, Ryan from blockstocks.com. I'm going to do a quick follow-up video on selling volatility and trading a squeeze in Forex as a follow-up to my article in medium.com. This is the micro futures of the S&P, ticker MES/MES. And Monday, the market was sent downwards, and honestly, I wasn't really surprised for a couple of reasons. I'm going to kind of come out of this here and just show you. In one of my other articles, I wrote about max pain level and market makers, and you're going to see that in monthly expirations, my belief is that market makers will want to force price down past a certain level to cause maximum loss to retail traders and maximum gain to the market. And so these dotted lines represent monthly expiration. And I would say most of the time, not always, for example here it didn't happen, but most of the time the price is forced down to almost the lower Bollinger Band every monthly expiration. And certainly it happened here, but we've got this almost excessive downward movement. So in these instances here, 1, 2, 3, it touched there and immediately bounced back up. But in this instance, it touched down there, and we have these red bars, which is equivalent to what's happening down here in the Squeeze Pro indicator. Now, the Squeeze indicator is available in Thinkorswim as a generic indicator. But this particular one, Squeeze Pro, is sort of like the juiced up version that'll show me different strength of squeezes with red, black, and sometimes orange, whereas the generic version will only have red squeezes and can sometimes miss squeezes. So this one here detected a squeeze that was about to fire to the downside, and then in fact did fire one day before monthly expiration. And as it did, we're going to expect at least maybe 1, 2, 3, maybe 2 or 3 days of this downward kind of movement. So we're at 2 bars here. So my thought is that today we might get a bounce just as a reaction, like a knee-jerk reaction. But my thought is that we're going to get just a little bit more downside movement before we hit a level of support and make a bounce back up. So it is interesting to have this knowledge, because if you kind of know that happens every monthly expiration, you could trade to the downside around monthly expiration if you see that that's happening. And then if you don't see any carryover of the negative momentum, that you could then plan on trading an upside trade here as it bounces off the lower Bollinger Band. Now you would have to check volume and other indicators to see if it's going to bounce or to see if it's going to carry down. So it's a little bit difficult to trade this right now, because normally it would just bounce back up and you can, trade up. But this one, I'm not sure if it's going to, today it's trading up, but it hasn't breached the previous candle, so it's not a confirmed reversal. So it's trading up, and then my thought is that it's going to continue to trade a little bit down before it goes back up. So let me change this to SPX just to show you how that looks. And it's very similar, because the micro futures is basically the S&P, the SPY index, and the SPX is 10 times Roman numeral 10 times the SPY. So the chart is basically similar, off just by a little bit. And so on this chart, I've actually drawn in Fibonacci levels. And it's very interesting that the price is moving and respecting these Fibonacci levels. And I drew these levels from the previous low to high. So if I were to cover this part of the chart and had drawn these levels, I would not know what was going to happen in the future. But interestingly, the price has bounced off of these very levels here and down here. So it's so, I don't know if it's a coincidence or a matter that the market makers look at these numbers. Probably that they just look at that too. And so as this squeeze fired, today we're going to get some kind of a little knee-jerk bounce, but my thought is that we're going to get just a little bit more down movement. Now, what we have to look out for is if it's going to continue to respect this level, 4,300, and then bounce back up, or if it breaches this level of support, then the next level of support that I would think is this 42.43 or 42.45 level. Now let's look at the open interest to validate these levels. So this is September 24th, which is Friday. And what I like to do is look at where it's trading now and then scroll up on the put side. So we've got a big number of open interest there, 43.50. But then, boom, we've got a big open interest wall at 4,300. Let's look at where that coincides on the chart. Interestingly, 4,300 is this first level of support. So as a market maker, first of all, as a retail trader, I would want price to go below 4,300 to make money. So if I was on the opposite side of that trade as a market maker, I would want to keep price above 4,300 in order for all of these puts to lose money. So it's a little bit different to think of it on the opposite side of the trade. But think about it, market makers have all of the inside information, so they have the upper hand when it comes to where to put the trade. So if it was me, I would actually try to think opposite to what the masses are doing, and I would try to, maybe either try to sell puts above the 4,300, such as a put credit spread. So let's look at the chart. So maybe, and I'm not saying to do this yet because there are other things we have to check. So maybe you could sell a put credit spread to keep price above this level by Friday. Now that could change by Friday, so I'm not going to enter that trade. Let's just evaluate or assess the other side. So now we're going to look at the call side. Let's look at where the open interest levels lie there. So we've got there some. We have 4,400, but the next biggest level was this one here, 3,900 at 44.50. Let's look at where 44.50 coincides. 44.50 coincides with right here at this level here. And then there was another level here, 4,400, which coincides with about the top of this candle. What does that tell me? It tells me that if I were the market maker, I would want to keep. Okay, so as retail traders, if you bought calls, you want the SPX to trade above this level. So on the opposite side of that trade, a market maker would want to keep price below 44.50 or even below 4,400. Let's look at what that means in the chart. So if you want to keep price below this level or this level, that means that our trading range is somewhere in here by Friday, by this Friday, September 24th. In terms, and if the market makers can keep price between these levels by Friday, then as of today, the most retail traders will lose the most money. Now, it doesn't always hit that range because the market makers are basically trading against everyone else. So the next level range was way up here. So if they couldn't keep price here, most likely they're going to try to keep the price between this level of 44.50 and above this level of 4,300. Now let's look at one more thing. I'm going to pause this for just a second. And this is called MaximumPain.com. It's a very simple website, and it does have educational videos and explanations and some explanations of trading strategies. It's a really nice site, and it's free to use. So please visit their website and check it out. On their side, they have lots of calculations here, but what the number I like to look at is this number right here, max pain. And what it's saying is that at this level is going to cause the most damage to retail traders' trades. And that's really an interesting number, because if we look here at our trade here, it was 441, and on that the SPX is 10 times that, so that'd be this basically 4,400. So what that means to me is that market makers are going to want to keep price below this level and above this level. So that's just confirmation to me that by Friday, market makers might try to keep price in this range right here. Knowing that, you can either sell a put credit spread above 4,300. I would actually maybe choose something more down here as protection, or maybe even down here if you can, this other level. It's going to be safer to trade down here, because if you put your put credit spread here, you're going to risk some loss if the candle happens to trade below that. Likewise, even if this is the max pain level here, to try to keep price below that if the candle happens to trade above that, you could lose. So it would actually be safer to sell a call credit spread somewhere up in this range, keep it below a certain range up here, or to keep it above this kind of level here. If you do it that way, you have a little bit of a cushion here that you can still profit from the trade, even if the trade's beyond this range here and this range here. And so on my trade here, I actually have an order in to sell a call credit spread using this 44.50 level, which was just the highest open interest, and where it corresponds on the chart was about right there. And the reason I didn't want to sell a put credit spread above this range or above this range was because my indicators were telling me that there could possibly be a little bit more downside as this squeeze fires. So that's how it looks in the SPX. I'm going to stop this video, and I'm going to include a second video on how trading the squeeze in the Forex pair.